Oh, sorry. I'm sorry, I wasn't recording and nobody reminded me. If the market is trading below the 50 and 200 EMA, comma, then directional bias is bearish. I hope this clarifies a lot of things. So, like I said, I use the 30 minutes, 4 hour, or the daily time frame for this purpose, as depending on how long I want to hold this trade. Now, invariably, so if you feel comfortable on the 30-minute time frame, fine. If you feel comfortable on the 15-minute, fine. If you feel comfortable on the 5 minutes, fine. But the choice of what time frame you use, I don't want to enforce it at this point. But this is how I do my thing. So now, the blink period is between the 8 to 10 a.m. GMT plus 1 time, and also between the 1 to 3 p.m. GMT plus 1 time for New York, okay? New York, and I will say this one also for London session. So now that we understand our directional bias and how to look at it decisively, now I want to talk about inducement and initiation. Inducement and initiation are both both have the same features, but they work from different perspectives. It is the positioning of the creation of this inducement or initiation that tells the different role they play. It is a way the market maker tend to make fast trigger on a position, either in the right direction or in the wrong direction, and then taking their stop loss before the intended move is started. I mean, inducement and initiation has the same feature, but the positioning is what differentiates them. So what is an inducement? Now, inducement is, so inducement equals to triggering traders to take a position in the wrong direction that is intended, okay? I hope that is a wrong direction. Let's say the market intended to go bearish. Now, let's say bearish like this now, and the market chose to go this way and then come down, right? So people that had the entry at this point and bought will possibly be expecting it to keep going up, but the market eventually went down. That is an inducement. Okay, now let's talk about initiation. Initiation is more or less like creating a move, then that move was actually the right move, but the market later make a pullback to mitigate that move before later continuing. The essence of the mitigation is for two purposes, so that the banks that makes the move initially that were left out from that initial move will later find a better entry. One. Then the second one is that the people that took let's say for example now, I'm going to initiate a move. Now, the market actually wants to go down. I want the market to go down in this way, like this now. So what now happens is that the market now shows to go down, right? But instead of, when it went this down, maybe it went down with a wide range candlestick, out of a whatever, immediately it went down. People that actually want to trade with the market, they will quickly take a sell with the hope that it will continue going down, market, and put their stop loss within the body of this market. So when they put the stop loss here, the market maker knew that the stop loss has already been placed. Then they will go up, 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 they will go up like this, and then later continue to sell the market. Why did they go up in the first place? First, they mitigated this void that is created here, and therefore came back to almost the supply that was initiated, that was created to initiate this move before later going down. This is where our AR50 normally comes in, or AR00. And I will show you on chart how to see this in reality. Okay, so let's say, for instance, you want to take a trade today. You want to look at, in this case now, this is a case, if you're looking at inducement, this is a case of where the market makes a London type 1 pattern, stop onto the high, and then later starts dropping, and that is inducement. But when it comes to AR50 and AR00, this is a case of where the market made a move to the right direction, people sold, then we trace back against them, hit their stop loss before later continuing going up. These are the various liquidity engineering that happens in the London time frame. Now let's keep range expansion and reset until we get a clarity of this inducement and then initiation on our chart. So I'm going to take a little bit of screen grab here. I'll take a little bit of screen grab here, and I'll put this as a screenshot in the general group. Okay. So I just want a case where we all are open-minded as regards to what we are doing. Screenshot 1 is pay attention. This might not continually come for life. We just have to understand something here. So I will proceed, but I will clear this chart. Mind you, like I said, I'm going to revisit range expansion and reset. I would just want to discuss this inducement and show a chart example in line with directional bias. Like I said, directional bias is if the market is trading above the 50 MA and the 200 MA at the break period, directional bias is bullish. If the market is trading below 50 MA and 200 EMA, directional bias is bearish. The break period we're talking about is 10 a.m. to 8 to 10 a.m. GMT plus 1. And then the other one we're talking about is 1 to 3 p.m. GMT plus 1. And I hope this sets up a whole lot of things. Mind you, if the market is trading above the 50 MA, that is the trend, bullish. Mind you, this 50 MA could be temporarily violated. We expect the market to hold last barrier around the 200 EMA, and therefore we still expect the trend to remain intact as far as regards. Okay, but we all start with the understanding the position of the markets relative to the 2 MA, and therefore we come up with understanding our directional bias. Then when you understand your directional bias, we now look for one of these two. It's either we look for inducement or initiation. So let's come to the chart. I'm going to use a random chart for this purpose. Or in case you want to suggest chart for me, will you show live market example in this session? Yes. Please, in case you have a chart example you want us to look at, please suggest currency pair. If you are listening to me, suggest currency pair that you want us to take a look into. So I'll go to the chart, and then somebody said GA, so I'm going to use GA to begin, so that it doesn't become like, see, we add a concessional view as regards this. So this is GA on the intraday perspective. I want to, immediately I open this chart, I look at my 50 MA, which is the aqua line, and the 200 AMA, which is the white line here, and then my 13 AMA, which is the trigger MA here. So what do I want to do? I just ask myself, as at the break period, this is when this line that is showing here is the end of Asian, and that is here is the break period. As at the break period or the end of Asian, market was in trading below the 2 MA. So I summarily put my mind up and say, okay, daily intraday bias, directional bias is bearish. And this is the end of all the whole thing when it comes to trend analysis for that pair. And this bias stays, as far as I'm concerned. You probably can just check your own chart and come up with a rationale of looking at this thing. So now that I have a bearish view and I want to be looking for a sell, one thing that matters is this: liquidity must be very key. The liquidity I always want to see on my chart at the liquidity I want to see on my chart. The liquidity I want to see on my chart are obviously something like at this point now, liquidity I want to be seeing, I want to look at strap around the previous day high, previous day low, initial low of the day, initial high of the day, the midline of the Asian zone, the 200 EMA, and also the previous, in case I'm looking at the swing, I will be looking at the previous week high and low. But nevertheless, immediately you are in the break period, you need to identify the next two liquidity zones that are closest to the current market position. These are where the traps are obviously awaited. So immediately the Asian is closed, I find the high of the Asian at this point. So I will call that my initial high of the day. So IHOG, right? And that is cool by me. So I will now go to the next liquidity that is likely, which is the previous day high at this point. I will put this one as my previous day high. Now I want to look for a trade around the brink, and it has to be something I want to be very cool with. So I'm looking for a sell because directional bias indicates bearish since I'm below the MA. So then I want to be looking for an inducement in this direction. This inducement must be like, now, you can see that the market actually wants to, I'm looking for a sell, but I'm expecting that the market will first make a wrong move to create a trap, to trap people into believing that the market wants to buy. So this is inducement, okay? And I'm looking at inducement because the initial low of the day is far away, okay? If the market opens around this point, the London close around this point, I may be looking for an initiation. Initiation is market breaking out in the right direction of the trade. But instead of it continually going down, the market will now make a pullback into the whatever before continuing. This pullback is where the stop loss of the people that sold too early will now be washed out. Then we can now look for a safe entry. Always look for a safe entry into the range. Now, if the trend is intended to go down based on the directional bias, if the market break the initial low of the day, that is an initiation. And therefore, initiation is a breakout into the right direction of the market. But what happens next? There will be a mitigation. This mitigation process is a pullback into the initial range of break. And then at this point, the market will now continue to sell down. By that time, the people that sold at this point would have been washed out of the market, and you can find a very good whatever entry. The market maker will now renew the entry at this point and start selling down. That is initiation. But in this case, since the market was having a bearish perspective and the market chose to close at around the high of the day, I was looking for an inducement where the market will induce the initial high of the day and then create an M and start coming down. So if you look at the chart I posted to the group, I said sell stop at where? At this point, because I don't want to say sell at current price and market now go up and induce and before start coming down. So I want to see a sell stop. I want to enter the market when the market later fail above this high and recover below this low and then below the 13 EMA. Then I can find a sell in this regards to the downside. I hope this is clear. You must be able to identify your directional bias. It is upon identifying this directional bias that you can create a view for whether the market will initiate or induce. Initiation is if you are looking for a buy trade, the directional bias is bullish. You want, and the market opens, let's say you are looking for a buy trade now. Let's say the market opens near the initial low of the day, and you are looking for, let's say this is the Asian period, okay? Let's say this is the Asian period, and then this is the Asian high, right? So this is the 50% of the Asian. So the market now close at this point at Asian. Two things are involved. It's either the market goes up like this, come to the 250, and then sell down, or the market come down initially, first break down, and when it breaks down, people will sell, believing that the market want to start selling. Of course, the market want to sell, right? These are the AMAZE. The AMAZE is telling you directional bias is bearish. So we are looking at the London pattern formation. Directional bias was bearish. You actually want to sell, but the market closed near the initial low of the day. So what you do is you either expect an initiation. When the first breakout of the low, don't trade it. Market will always come back, pull back against it, either to the Asian low, like this, to give us our ARO50, ARO00, right? Or the market come back and trade back into the 50 line to give us the AR 50. In this case, the positioning of when the market is about to come back, the positioning of where the market will get to, whether to the AR00 or the AR50, is dependent on where the market, the 50 EMA is at that particular time of the day. So you can use your 50 EMA to filter out whether to expect a AR00 or a AR50. I hope this clarifies a whole lot of things. So let's take a look at another pair. In case you have another pair, so just another pair is that inducement to get in the area. Now, inducement is if a market want to sell, inducement is initial breakout to the upside. People will now buy, then they will now trap them and start selling. That is an inducement. If the market wants to sell, inducement is the market will first buy and later trap buyers and then start selling. But initiation is if a market wants to buy, the market break out in the upside direction and people buy. Immediately they rush in and buy, the market will reverse against them. When it creates a reversal against them and it will take their stop loss out initially, then that reversal will not come to haunt the Asian midline or Asian high of the day, then it will now start going up in the right direction. But the initial people that bought it earlier would have been washed out. We call it shake off. We call it sieving. It's either you call it sieving or shake out. So you shake them out of the market since they have weak hand and their stop loss has been taken out, then you now start going the right direction. So those are the kind of people that later come back and say, market took my stop loss and later went my way. You don't want to become a victim of that. Learn to avoid taking the initial breakout of London in the direction of the day because it is often considered to be an initiation. More than 70% of the time, market will make a retracement and pull back to the initial breakout point or at least to the Asian midline zone. Then you can start trading in the right direction of that day. However, if the market shows to give you a bullish directional bias, and initially it first went into a sell, right? That sell breakout is called inducement, inducing people to take a sell position, whereas the market actually intended to go in the bullish direction. So you don't want to take that part. Immediately that low is created, micro W is set, then you take the trade, immediately you have a shift candlestick indicating that we are now ready to go up. You must be able to understand the directional bias and stick to that directional bias until it is no longer valid. Okay, and that settles up a whole lot of things. Okay, now, so let's take a look at user. Like somebody suggests, I don't have pair I want to look at here. So user is currently having a bullish directional bias. No doubt, immediately you open a chart, you should be able to see it. This directional bias should come scaring or slapping you without you searching for it. Immediately you open your chart, where is the market relative to the 50 and the 200 EMA, and that is your directional bias. The next line of action is start looking for where the liquidities are. Now, on the user, I would say liquidities. Liquidity simply means idle fund, or let me say where people's stop loss are currently residing. Now, when the Asian high ended at this point, and then the Asian low at this point, so market closed near the Asian high. What market initially has to go up? What happened is that the market initiates. This initiation move is a buy. People already bought this market at this point. What happened? Market chose to mitigate. This mitigation came back to the midline of the Asian. Now we have the midline of the Asian up where. So this is the midline of the Asian. So expect the market to continue in the bullish direction, in the direction of the intended move. Okay, this is an example of initiation and then mitigation and then continuation. Now the process is initiation, mitigation, and then continuation. I hope somebody will learn something from this point. I chose not to open a chart and start telling you what happened yesterday. Okay, let's look at what is expected to happen and why it will happen based on critical understanding of the principle that we all claim to know. Now, I hope this settles a whole lot of things. So now, there's what we call daily expectation. There's what we call daily expectation. Daily expectation is often the ADRI, or low. Now, when you open your trade, you should be able to make sure that you should be able to say, okay, this trade that I've opened should take a course and run to the daily expected zone. So we use the daily ADRI and low as our expected markup. Okay, now on this pair user we have 245 pips, 249 pips. So I want to say I can as well run down to start looking for something like 200 or whatever. So that is like a so when you pick a trade around this AR50, this is an example of AR50 occurring after an initiation. Both AR50 and AR00 is a trade setup that occur in an initiated market. Market initiates, market mitigates, and then continuation occur around the breakout zone or the midline, and that settles it up. Now, the other one, like I want to say, please, my people, I don't want to sound insulting to the Btmm community. There are a lot of bullshit that we have on our chart. Take it off. You do not need all the AMAZE on the whatever. What you need majorly is the one that guides you, your directional bias. Then even the 30 AMA, you do not need it. You need principally ability to see nameable candle patterns set up, railroad track, engulfing, pin, and whatever. When you can identify a railroad track, and you can identify an engulfing, and you can identify a cord of wood, you do not need 13 EMA. Once you understand the setup and the pattern and where it's expected to play, so when you get there, nameable candle pattern occurring, you take a trigger as regards to what you are currently looking out to find. Okay, I'm sure you understand this, right? Now, if you take a look at this user, you see that the market made an initial first move, second push. So today we're going to have our third push around this point, and that's to settle up our peak formation high at this point. Then we can expect a retrace back to the initial low here. So if user make a new high today, we could expect a trap, because this will now be our first push, or let me say P1. Today is not for level. I may have another session for levels. Then I can come to say, if we have a new high here, we have our P3, and then we can expect something like a pullback in this regards, then before continuation, whichever the case may be. I hope you understand. But technically, a new high is expected to form today, and I hope I've been able to do justice to this topic. And this should be the end of this moment, and I hope somebody learns from this. Once again, I want to end. Before ending, I want to say thank you for joining me. I have so much respect for people who knows more than me and still chose to attend this meeting. And I want to say we have a long way to go together. Thank you very much, and God bless you. Do you have any question? I would like to open room for question. Okay, I will be the recording was done. I will share the recording. I will share the recording immediately after this meeting. So somebody talked about why did EU drop? EU drop because the directional bias on EU is bearish, and therefore you want to look for entry, right? So what happened is that this is the initial high of the day, and this is the initial low of the day at this point. So what happened is that before in the London market breakout, this breakout is called initiation, right? Market initiated. Please all learn this thing. Initiation is initial breakout in the right direction, but because the market maker don't want people to make money, so what they do is that they mitigate against that initiated move, come back into wherever, into the range, onto the stop loss, and then later continue to sell. And that settles it. This is example of an initiated market and market coming back to wherever. Like I said, if the 50 EMA is here, market has a tendency of coming close to the 50 EMA. Where the 50 EMA is the guide to where you should expect the initiation pullback mitigation to end, and then you continue in that regards. Okay, so you want to ask questions on anything, just feel free, and it will be very much open to it. TDI setting, the truth is, if you understand your pattern, and then whatever, most importantly, the TDI will just be a confirmation tool. You don't want to waste too much of time on that. But learn TDI, understand how to manage and understand the divergence principle as to regards to expecting where the peak formation are. But the most important thing is the liquidity engineering within the break period in the London zone. Understanding where to expect initiation and when to expect inducement and when to expect mitigation and then continuation. And with this, if you can do it structurally, you are good as far as I'm concerned. Okay, that's it. All right. Thank you, and God bless you. Bye-bye. Or there's any question, will you have a live trading stream? Would you like to whatever you want and how you feel you can learn, just let me know within the group. I will have it that way. But hopefully I expect this to be just the start, and we can continue having more and more sessions as we go on. And if you want to talk, you have a question within the next 5 minutes, I will enable the microphone. Okay, you want to discuss something with me, let me enable the microphone. Raise up your hand. Whose hand is this? I have Dynamite. So Dynamite, you want to say something? You are welcome. Please go ahead. You've been unmuted. Dynamic.
Please, I can hear you.
Okay, can you hear me now?
Yes, I can hear you now.
All right, sorry, I'm sorry. I think that was a disconnection. So what is the challenge? Anything?
I really appreciate your efforts. I've also texted you before on Telegram. You are doing well. I appreciate you a lot. But there is one thing I just want you to please put in mind when we are having a free session like this, because I believe it's a free session.
All my session will always be free, please. So don't let us add the clause paid or whatever. That I never will have a paid group, neither a paid class or a paid signal group or a mentorship paid. Everything will always come free. But I want a community that is open-minded as regards to wanting to learn, not just.
Of course. Thank you very much. Now
like imposing. Okay.
I get you. What I just want you to show me personally, I don't know if it's going to be in a general session like this. I need to understand how liquidity engineering works. I understand everything you've taught us today, but my challenge has always been, because I also know a bit of ICT, but my challenge is always to identify when they are inducing and when they are actually making the real trend.
No, now liquidity engineering.
I don't know if you understand my question.
Yes, liquidity engineering, let me put it, liquidity engineering is a concept I call how the work around the liquidity pool to create either inducement or initiation during the break period. Okay, I have explained this earlier on. I don't know whether maybe you did not join us on time, but I think I explained that how the work around the liquidity pool. So I said the liquidity pool are always expected in the market at the previous day high and low, initial high and low of the day, and what to expect has to do with where the market is trading relative to the initial, the closest liquidity that has been created in the market. Now, the liquidity that you want to trade should be either the initial high or low of the day, and also the previous day high or low. So now that you have made up your mind as regards the liquidity you want to, it has to be the one that are closest to the market. Now, let's say I want to look at this pair. I have a previous day high here. That is a liquidity. Abi?
Okay,
people that
yes.
sold here, people that sold here kept their stop loss here, Abi, behind.
Of course.
No liquidity are stop loss. We call it idle fund, Abi.
Of course, of course.
So somebody equally bought at this point. Stop loss is currently around this point. So this is equally another liquidity. Now, somebody in the Asian high, this is the initial high of the day. This is equally another liquidity. Now, the Asian low of the day is equally here. This is equally another liquidity, right? Now,
yes,
Btmm said, okay, there could be a stop hunting, not more than 50 pips in the London session, Abi.
Okay.
But
yes,
I called that assumption. The reality is that the stop hunt zone should be maximum of two boss, two times the Asian range. So when we talk about the Asian range, this is the Asian range, Abi. You bring it here.
Yes.
Then you bring it here. That is maximum of the 2 times the Asian range.
Okay.
So like ICT or whatever, call it 2 standard deviation of the Asian range. That is the stop hunt zone. So by calculation, it is expected that the market will not make more than 50 pips in the Asian. Abi?
Yes.
So Btmm now assume that the stop hunt should not be more than 50 pips away from the high. But in reality, what that is expected is maximum of 2 standard deviation of the Asian range.
Okay.
So we now have to create, that's why I don't have the stop hunt boss on my chart, because if the Asian range did 7 pips, the maximum stop hunt zone will not be more than 14 to 15 pips.
Okay, yeah.
Not 50. By the time the market break out of the Asian range, which is 7 pips, and move 50 pips, the day move is over, not longer a stop hunting.
Of course.
You get the logic.
Of course.
So
I get it.
the market you are trading will determine its stop hunt zone, not you assuming the stop hunt zone should be. What if you are trading a currency pair like Euro CHF that has a daily range of less than 30 pips? So, and you create a stop hunt zone to be 50 pips, and by assumption, generalizing the market, it doesn't work that way. There must be conceptualization of the process and understanding how it works for you to be able to make a living from it as a trader. Now, once you identify this, you can create a preview. So now the market has violated the initial low of the day. This is what we call an inducement. Sell has been initiated to the downside. Okay. Actually, I had a buy at this point. Now, when I had a buy at this point, I'm looking at this zone, right?
Yes.
Then, that is a consolidated area of consolidation, Abi.
Consolidation, yes.
Now I'm looking at this zone. So if this zone is not respected, there is what we call, there's a doji here, Abi.
Yes.
This doji, base of this doji is very important because that is a base candle. That is where the market finally consolidated before the successful breakout of this zone at this point. And that is very important to me. This is why I said for you to trade Btmm effectively, there will be a need for you to understand the principle of supply and demand. And a little bit of SMC liquidity concept. Okay. I'm going to take this class with everybody in the group if they chose to learn one by one, and it will not be anything different from what Steve would have taught if he actually want to do the right job. Thank you very much, everybody. I would like to
thank you so much.
I have another class.
Thank you so much. Thank you so much.
You're welcome, sir. All right. Bye-bye.